on this March 11th, in a couple of weeks, it'll be 77 years since I bought my first stock. And I paid $114.75 for 3 shares of City Service Preferred. But if you had if you'd been a pension fund and you put $1 million into the S&P 500 at that time and reinvested it, during my investing lifetime, that million would have turned into $5.3 billion. You would have gotten, for every dollar you put in, you've gotten over $5,000 without ever reading a headline, an annual report. You didn't have to know accounting. You just had to believe in America. And you didn't have to pick the right stock. You just picked America. I go back and I point out that there were 2 77-year periods before that, and that takes us back to George Washington getting inaugurated. And there wasn't anything here then. And now you have $108 trillion of household wealth in the United States. You know, we've got something that works. And that framework wasn't that we were working harder, it wasn't that we were smarter, but we had a framework that unleashed human potential. And just think of that, 3 77-year periods, one of which I experienced. And you couldn't help, but all you had to do was believe in America.
That worked the last 77 years, but there's a question that came in, T29. This is from Scott Baker. With so many people in the S&P index funds, is it still market neutral and the best investment vehicle for most people?
Yeah, I think it's the best investment, because most people don't know how to pick stocks, and most of the time I don't know how to pick stocks. I mean, it's not an easy game, and by definition, people are going to do average. I mean, take everybody in aggregate, and if half of them are paying big fees and jumping around and paying brokerage commissions, the other half have to do better.
Well, if we had both a big hurricane in the Northeast or in Florida, and we had a big quake in California in the same year, and we had a financial market, the financial markets tanked, perhaps because of those events, but perhaps for other reasons, we would be thinking about ways, it might not be borrowing money directly, but we would be thinking about ways to buy securities if they got cheap enough. I mean, anytime securities get cheap, Charlie, you're thumping again here. Anytime securities get cheap, you know, we don't like to go to the office and not write a ticket. I mean, we certainly would have the ability to borrow some money. We would never borrow a ton of money relative to capital. We're just not set out that way. We don't want to disappoint anybody in this world. We don't even want to worry about disappointing anybody in this world. So we're not going to do that. But we have a lot of extra firepower overall. And I would say under almost any conditions that cause securities to get very cheap, we would find a way to buy some of them.
I have an old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, you know, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. You know, if you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. There can be all kinds of companies that have wonderful futures, but I don't know which ones they are. I've given talks in the past where I carry with me a 70-page, tightly printed list, and it shows 2,000 auto companies. Now, if at the start of the 20th century, you had seen what the auto was going to do to this country, the impact it would have on the lives of then your children and grandchildren and so on. It transformed the American landscape. But if those 2,000 companies, you know, 3 basically survive, and they haven't done that well at many times. So how do you pick 3 winners out of 2,000. I mean, it's not so easy to do. It's easy when you look back, but it's not so easy looking forward. So you could have been dead right on the fact that the auto industry, in fact, you probably couldn't have predicted how big an impact it would have. But you wouldn't have, if you'd bought companies across the board, you wouldn't have made any money, because the economic characteristics of that business were not easy to define. I've always said the easier thing to do is figure out who loses. And what you really should have done in 1905 or so, when you saw what was going to happen with the auto, is you should have gone short horses. There were 20 million horses in 1900, and there's about 4 million horses now. So it's easy to figure out the losers. You know, the loser is the horse. But the winner was the auto overall. But 2,000 companies just about failed. A few merged out and so on. There were 3 companies, auto companies, in the Dow Industrials in the 1920s and 30s. Studebaker, Nash Kelvinator, and Hudson Motor. Now those names are all familiar to me, and maybe some of them are familiar to you, but they're not making any cars. You know, they didn't make money, and yet at one time they were in the Dow 30. They were the aristocrats of American business, and they got creamed. So figuring out the economic characteristics of the winners in a wonderful business is not easy. In North Carolina, you know, Orville and Wilbur took off. Well, I guess Orville took off and Wilbur watched. I'd have been Wilbur. But if you could have seen the future of the airline business from that point forward and how that would transform things, you know, it would have blown you away. And it's excited people, incidentally, ever since. But if there had been a capitalist at Kitty Hawk, he should have shot Orville down. I mean, because it's done nothing but cost investors money. There were over 400 airplane companies in the 1920s and 30s alone. There was in Omaha. There was in Nebraska. We were the Silicon Valley, apparently, of aircraft. And they all disappeared. It's been a terrible business. At the end of 1991, if you'd added up the aggregate earnings from all airline companies with billions poured in, since Wilbur and Orville were down there, they came to less than zero. The number of passengers went up every year. You know, the importance of the industry was dramatically increased decade by decade, and nobody made any money. So figuring out the economic consequences, TV, I think there's, 20, 25 million sets a year sold in the United States. I don't think there's one of them made in the United States anymore. I mean, you'd say TV set manufacturer, what a wonderful business. I mean, everybody, nobody had a TV in 1950, or thereabouts 45 to 50. Everybody has multiple sets now. Nobody in the United States has made any real money making the sets. They're all out of business. You know, the Magnavoxes, the RCAs, all of those companies. Radio was the equivalent of the 20. Over 500 companies making radios in the 1920s. Again, I don't think there's a U.S. radio manufacturer at the present time. But Coca-Cola, you know, what was it, 1884 at Jacobs Pharmacy or whatever, the fellow comes up with something. A lot of copiers over the years. But now you've got a company that is selling roughly 1.1 billion 8-ounce servings of its product, not all Coke, Sprite, and some others, daily throughout the world 117 years later. So understanding the economic characteristics of a business is different than predicting the fact that an industry is going to do wonderfully. And so when I look at the internet businesses, or I look at tech businesses, I say this is a marvelous thing, and I love to play around on the computer, and I order my books from Amazon and all kinds of things, but I don't know who's going to win. And unless I know who's going to win, I'm not interested in investing. I'll just play around on the computer. And defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, I'm no genius, he said, but I'm smart in spots, and I stay around those spots. And, you know, that is the key. So if I understand a few things, and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, and the stocks are going up and everything, I start fooling around someplace else, eventually I'll get creamed, and I should.
As I explained, the position isn't that huge when I look at worst case possibilities. I would say that there are things that I think are quite improbable, and I hope they don't happen, but that doesn't mean they won't happen. I mean, for example, in our insurance business, we could have the world's or the country's #1 hurricane that it's ever had, but that doesn't preclude the fact we could have the biggest earthquake a month later. So we don't prepare ourselves for a single problem. We prepare ourselves for problems that sometimes create their own momentum. I mean, 2008 and 2009, you didn't see all the problems the first day when what really kicked it off was when the Freddie and Fannie, the GSEs, went into conservatorship in early September. And then when money market funds broke the buck, I mean, there are things that trip other things, and we take a very much a worst case scenario into mind that probably is a considerably worse case than most people do. So I don't look at it as huge, and I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote and never pay it. You don't need to pay attention to them. I mean, the main thing to do, and you're not going to pick the bottom, and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more and be comfortable with it as long as you're comfortable with the holding. And I pointed out, I think a year, maybe 2 years ago in the annual report, just the one before this most recent one, I pointed out that there have been 3 times in Berkshire's history when the price of Berkshire stock went down 50%. 3 different times. Now, if you owed it on borrowed money, you could have been cleaned out. There wasn't anything wrong with Berkshire when those 3 times occurred, but if you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, I mean, how can you stay with that when something else is going up or anything? You've got to be in the right psychological position. And frankly, some people are not really careful. Some people are more subject to fear than others. It's like the virus. It strikes some people with much greater ferocity than others, and fear is something I really never felt financially, but I don't think Charlie's felt it either. But, some people can handle it psychologically. If you can't handle it psychologically, then you really shouldn't own stocks because you're going to buy and sell them at the wrong time. And you should not count on somebody else telling you this. You should do something you understand yourself. If you don't understand it yourself, you're going to be affected by the next person you talk to. And so you should be in a position to hold. And I don't know whether today is a great day to buy stocks. I know it will work out over 20 or 30 years. I don't know whether it'll work out over 2 years at all. I have no idea whether you'll be ahead or behind on a stock you buy on Monday morning or the market.